Howdy, Jacob here. Today we're looking at Flex in the electronic equipment, instruments, and components industry. Just over 15 billion market cap and enterprise value. They provide manufacturing solutions to various brands globally. They operate mainly through their Flex Agility Solutions segment and their Flex Reliability Solutions segment, founded in 1969, headquartered in Austin, Texas. Their revenue growth has been essentially flat over the last 10 years, with revenue in 2015 at 26.1 billion, and now 26.4 billion is their 2024 revenue. So pretty much flat, with gross margin in the single digits and operating margin in the single digits. The only good news for that is that they are both growing, which is positive, but it's only so much you can grow that bottom line when your gross margin after cost of goods sold is 7.1%. With that said, return on invested capital historically mid to upper single digits, and return on asset mid single digits. So nothing crazy impressive there. Income statement definitely shows a hefty, 90+% of revenue as expensed for cost of goods sold. Their balance sheet has 2.5 billion in cash-like equivalents and 3.3 billion long-term debt. So you're looking at about a little less than $1 billion net debt, and they've made that in the rolling 12. So not terribly concerned with the balance sheet based on the cash they have and the cash they have produced the last couple of years and the debt they have. Not terribly concerned about it. Their use of cash recently has been very heavy on share repurchases, and they've made one decently sized net acquisition in 2022 of over $500 million, and bought back some debt, but majority of their capital allocation appears to be share repurchases. So that's enough to get me to make some assumptions here on the revenue growth side. I mean, it's looking pretty much flat. I'll probably assume pretty much the same. I think a low growth business with not a lot of debt definitely doesn't deserve any type of premium, and definitely needs to be below market average of 14 to 16 or so. Margin average here includes some zeros, so maybe let's do 3 and 2.5%. Share change 1% is about 150 million, and roughly, let's say they make $500 million. That should get them able to reduce share count about 3%. And with these current assumptions, we're saying it needs to fall almost 80% to get to the price we're looking for. So it is very expensive based on this review. I don't think, it's a fantastic business. So this is definitely something I'd want to get cheap. I don't think it's going to necessarily grow into your valuation like some of those high flying companies that you might buy for a 40 or 50 current PE for. I don't see that here. And so interesting business based on initial financial analysis, but nothing crazy that I want to dig into at the moment. Hope you enjoy the video. Have a great day.